Welcome back to the second part of the complete guide to selling puts. This is Lynn from MathPhdTrading. 2-3 weeks ago, I shared a post about my channel on my LinkedIn page and got some boosts on my video views and subscribers. Thank you if you get connected from LinkedIn. And of course, much thanks regardless how you get connected to this video. To be honest, putting my option trade experience in my LinkedIn page was a milestone, just like starting this YouTube channel. It is my recognition of myself, like telling myself, you are doing something worthy, and you should let the whole world, including your LinkedIn network, know, even if you were laid off. So back to the video. This video is probably the most important and the most technical trading video that I've ever made. You will learn how to enter a trade, when to close a winning trade, and when to close a losing trade. So far, we have introduced the puts, calls, and all the Greek letters. We'll cover the rest of the basics. As a machine learning engineer and data scientist, I'm accustomed to applying metrics to measure the success of a project. So what should be my metrics to measure option trading? The natural choice is annual rate of return, ARR, since it does not depend on the size of the portfolio. In our case, for each trade, it's defined as a premium divided by strike price and then multiplied by the time ratio of 50 weeks, divided by the number of weeks to expire. For example, a put trade has a strike price of $100 and a 1.5 premium and expire in 4 weeks. The ARR from this trade is 1.5 divided by 100 times 52 divided by 4 equals 19.5%. So if the stock stays flat or doesn't move down very much, then you can keep sending this kind of puts every 4 weeks for over a year to get a 19% of ARR. Of course, stuff happens and stocks do move up and down. So if you have no cash in your account, your strategy should be sell puts and roll out. If you do have cash, you should practice the wheel strategy. I will talk about the rollout extensively in the later part of this video. And as for the wheel strategy, if you don't know it, there are many YouTube videos covering it. I also have one video to discuss whether the wheel strategy works better than the stock market or not. You should watch it if you haven't. So depending on different strategies, you expect a different return. Rollout strategy is lower than the wheel strategy. Since I mentioned the expected ARR last slide, let me lay out my assumption of such an expectation. I have 2 assumptions. One is the stock market fluctuates in the short term. This is the reason we gain premium when we sell puts and calls. The higher the volatility, the higher the premium. This also means if you know that a stock will rise in a short term, through your analysis or your observation, you should buy the stock instead of selling puts. Because when you sell puts, you only get a fraction of that stock upward movement. 2, the stock market will eventually rebound if it recedes. If not in 6 months, it will rebound in 3 years. This assumption determines my rollout strategy. My new trade has a similar strike price, a further expiration date, and a larger premium. In this way, you collect more time value while the stock is recovering. But this assumption doesn't apply to meme stock. GameStop was as high as $300 in 2021, and today it is $12. Imagine you sell a put at $300, you probably won't see the stock go back to $300 in your lifetime. In the theta slide, we talked about implied volatility, but I think it deserves more attention. We know IV is defined as the market's forecast of a likely movement in the underlying security, and it's mainly determined by demand and supply. It is also impacted by the stock price movements. When the stock price goes down, the IV is up. When the stock price goes up, the IV is down. This actually has a very interesting impact on puts. When the stock price goes up, the put trade price is down due to delta. And because the IV is down, the put trade price is down even more. So as a put seller, you get this extra bonus. But the reverse direction is bad for the put seller. When the stock price goes down, the put trade price is up due to delta. And because the IV is up, so the put trade price is up even more. Lastly, I will mention VIX. It's a real-time index, and it uses price data from near-dated, near-the-money S&P 500 index option to project expectations for volatility over the next 30 days. It's a popular index for many traders. Because the stock market has been steadily rising in the last year, VIX has been in the range of 12 to 20 for 95% of the time. And there were less than 10 days, mostly in October, with VIX higher than 20. And in those days, SPY dropped to $410. And now it is $505. If you bought stocks in those days, you should have a gain more than 20% in 7 months. So if I were to develop my VIX trading strategy, I would say buy stocks when VIX is higher than 20. This week, actually, VIX has reached the highest of the year, 18. So if in the next couple of weeks, the market drops more, VIX might get to 20. Based on my observation of all my 50 plus stocks, I have defined the low IV as less than 30%, medium as between 30 to 45%, high as between 45% to 70%, and extremely high as 70%. In the second table, I show that for the same strategy, the expected ARR is very different for different ranges of IV. My strategy is to sell a put expiring at 4 weeks with delta minus 0.16 and calculate the ratio between premium and strike price and then multiply 52 divided by 4 to get my ARR. So when the IV is low, your ARR is only 8.2% like Google. Medium IV gives you 12% ARR. High IV generates 16% ARR. And Upstart generates 32% ARR. Of course, you cannot take this literally. This is based on the assumption that the stock stays flat. If the stock rises, your ARR will be more. If the stock drops, your ARR will be less or even negative. So where can we find IV for each stock? From Think or Swim, it's located at the bottom left side under today's options statistics. Here, I also want to introduce IV percentile, which is the percentile of current IV against the historical range of IV in the past year. So a stock could have a high IVP and low IV, and it could have low IVP and high IV. The former situation usually happens around earnings time. One of the most important basics are intrinsic value and extrinsic value. You have to know how to calculate it before you trade any options. First, option trade value equals intrinsic value plus extrinsic value. And for a put trade, intrinsic value is easy to calculate. It's not zero, only when the trade is in the money and the value is strike price minus the stock price. And the extrinsic value is time value plus IV value, which I did cover how to calculate them approximately. In the next slide, I will. Note that the exact way to calculate extrinsic value is quite complicated, and it involves a sophisticated physics model, Black-Scholes-Merton model. I never tried to understand it. So if you do, let me know. For me, understanding the direction of the extrinsic value changes by different factors is good enough. This is the slide that I made from my earnings trade experiment. If you haven't watched that earnings trade experiment video, you can do so. So on 2024, January 19th, Tesla closed at $212.19, a 212.5 put trade that expired in a week on January 26th has a premium of $7.2. The intrinsic value is just 31 cents. So the rest of them are extrinsic value, which is 6.89. And we can calculate the time value approximately as there are 5 days left and theta is 0.61, so that's 3.05. So the rest of is 3.84, that's the IV value. And the IV value shrinks dramatically after earnings. It's called IV crash. This is why people trade earnings. In fact, earnings are coming this week, and I will start my earnings trade again. Of course, I won't make a video about it this time, but I do have a WeChat option trade group. I will share some of the earnings trade that you are welcome to join us. Now that you know about intrinsic value and extrinsic value, you probably can guess the 3 influencing factors of an option trade price. One is the stock price movement, and this is related to delta. For a put, if a stock moves up $1, the trade price reduces the absolute delta value. The second is time lapse. Every day that passes, the trade price decreases, and the amount is the theta value. The last is implied volatility change, i.e. Vega. If there's no IV change, then you don't see impact from this. However, these 3 factors also impact each other. We call it the secondary effect. For example, for an out-of-the-money put trade, when the stock price moves down, the trade price increases due to the delta effect. In addition, IV increases due to downward movement of the stock price. Therefore, that also increases the trade price. Furthermore, because now the gap between the stock price and the strike price is smaller, and we mentioned that the time value is the highest at the money or near the money. Therefore, you probably see the trade price increases from the time value increases. Again, as I said before, we don't need to understand the Black-Scholes-Merton model to trade options, but we do need to understand how these factors impact the option premium. This is the last slide of the option basics, but it's not the least important. Any investor knows the importance of diversification. So is an option trader. When you pick a put trade based on the delta, say minus 0.16, it means this option trade has a 16% probability of becoming in the money by the expiration date. This is not necessarily true if you only have a few stocks. In probability theory, the central limit theorem states that it is true only when the number of stocks is very large. So to be statistically significant, you need to have 50 to 100 stocks. Of course, if you have less than 50K, it is impossible to own that many stocks, but at least sell for more than 10 stocks from different industries. And for each stock, only sell 1 to 3 contracts. So if one stock goes down, it doesn't drag you down too much. From a few slides ago, we know high IV stocks give you high ARR, and ARR is our North Star. I only sell 1 contract for low IV stocks and more contracts for high IV stocks. Also, another diversifying technique is when you sell multiple contracts on the same stock, enter trades with different strike prices and different expiration dates. In this way, when a significant drop happens, it doesn't hit you all at once. Okay, finally, we get into the real stuff. How do you sell puts and make profits? My strategy is to choose a delta between minus 0.24 to minus 0.16. So the strike price is usually 5 to 20% lower than the current stock price. And the trade expires in 3 to 6 weeks, so it gives you some time to maneuver. And I make sure the premium is more than 1% of the strike price. If you trade wins, that's cool and fun. And if you always think about your trade ARR, you can be even more on top of your game. My simple technique is to close the trade when the gain is larger than 50% and delta larger than minus 0.12. The reason we do this essentially is to maximize your ARR. I will give you 2 scenarios of one put trade to demonstrate. So when the stock price is $79, we enter a put trade as a strike price $72, expires in 31 days, and the trade price is 1.43. The first scenario is 3 days later, the stock price has moved up $4, and the trade price decreases to $0.4. You still have 28 days to go to realize the remaining $0.4. Do you close it? So the ARR calculation gives us 7%. Not too bad, but compared with 10 to 20% of baseline, it's a good idea to close the trade and open a new trade, following the same principles. Another scenario is the stock stays flat and moves down a little after 28 days. Now the stock price is 74. Of course, strike price is still $72. The trade price is 0.67. We already gained more than 50%. Do we close it? Right now, because it's only 3 days away, so if we calculate our ARR, would be 0.67 divided by 72 times 365 divided by 3. And that's equal, that equals 113%. So you definitely agree with me, we do not close this. We can also look at it from the time value point of view. The theta is 0.34. It's a $34 a day, and it's almost 0.5% daily. Remember I talked about theta trading, and the goal over there is 0.1% daily time value. It's what we aim for. So we definitely don't want to kill the fat goose here. Here I listed all of the reasons to manage winners. Besides improving ARR, it can lock in profit and remove risk from the table. But please note, if you open a new trade, you will have new risks. It also improves the probability of profit. And this is probably real. Let me explain. So when you sell a put with a delta minus 0.16, it means that there is 84% of chance to be out of the money by the expiration date. This means if you do nothing, the stock will be out of the money 84%. However, as the stock fluctuates naturally, and the moment you catch the stock price rise, and with more than 50% gain, you close it. So this behavior should increase the 84%, maybe to something like 87 or 90%. I don't know. Managing losers. So this topic is probably what you care about most. Nobody likes a losing trade, but it will happen sooner or later. In Tasty Trade YouTube channel, it recommends to adjust a losing trade 21 days before the expiration date. I tried it and then thought about it and decided that's not the most optimal. So when do I close the losing trade? Because my trade strategy is to earn the most time value or extrinsic value, I propose to manage losses when the extrinsic value less than 0.5% of the strike price. When this happens, either it's close to the expiration date or it's very deep in the money. You must have the fear that your in-the-money trade will be assigned to you. It's possible, but unlikely because the put buyer is paying extra for the extrinsic value when they close the trade. So let me give you an example. On January 25th, after earnings, Tesla dropped from 210 to 190. So this is a put trade with strike price 225 and expiring in 1 day. The trade price is $35.49. At this point, the intrinsic value is $35. Then the extrinsic value is only 49 cents. And because 49 cents is less than 0.5% times the 225 strike price, so we roll out this losing trade to generate more extrinsic value. How do we roll out? So we would pick a strike price that is 2% lower than the strike price in the losing trade. And you find the closest expiration date that gives us enough premium. And this enough premium in my formula is the losing trade price plus at least 30 cents. So using the Tesla example, we talked about the trade one at January 25th only has extrinsic value 49 cents and the trade price is 35.49. So the trade number two, so you close this one and you open a new trade number two. The strike price is 2% lower, so that's $5 lower than 225. Then that's 220. And the trade price needs to be higher than 35.49. And we find out when we push to May 17th, the trade price will give us 36.57. At this point, the extrinsic value is $6.57 because the intrinsic value is $30. This is how we roll out the losing trade. For that trade number two, we have a question: when to close this trade number two? Actually, the answer is the same. We close the trade when the gain is larger than 50% and delta between minus 0.12 to 0. So I'll give you an example. If Tesla rises to 220 in 3 days, then our previous Tesla trade will have a 50% gain. And at this point, delta is minus 0.5. So do we close this trade or not? The answer, simple answer, is no. And the reason is because delta is not between minus 0.12 to 0. And another way to explain it is if you close this trade right now, you are going to lose a lot of money. Assuming the trade number 1 original premium is $3, you gain from closing trade number 2 at trade price $18 is minus 18 plus 36.57 minus 35.49 plus 3 equals minus 13.92. So you lose almost $1,400 from this trade. This is almost the last slide. I want to explain a bit about why lower the strike price 2%. I mentioned that I want to be more careful since the stock has moved down a lot, and lowering the strike price a little bit makes me feel more comfortable. I also think this strategy is quite optimal if the stock stays flat or moves down based on my Enphase Energy case study. I determined that even if a stock drops 20%, I could still earn 11% ARR with this roll-out strategy. So my assumed scenario is after a stock drops 20%, it stays flat for the rest of half a year. I assume this so I can get the trade price from Thinkorswim. So all this data, including the trade prices, were taken from Thinkorswim of Enphase Energy. Last November, it dropped from $98 to $78 after earnings. So this table has many rows. Let me go over the first 2 rows slowly. When the stock price is $98, we open trade number 1, 4 weeks put trade with a strike price $88 and premium $2. Unfortunately, at some point of the 4 weeks, the stock dropped 20% to $78. So at the end of the 4 weeks, the stock price is 78. We close the trade number 1, and the trade price right now is pure intrinsic value, $10. So we lost $8 from the first trade. We open trade number 2, which is a strike price 86. And the trade price should be larger than $10.30. So we find the closest expiration date to make this possible, which is 7 weeks. At the end of 7 weeks, the stock price is still $78. So at this point, our trade price now is only $8. Because the strike price is $2 lower, so we gain 2.4 from the second trade. And we go on to the later trade, we always lower the strike price $2. And the premium is at least 30 cents larger than before. And you notice the expiration date or week is shorter and shorter. By trade number 6, our strike price is already the same as the stock price, and we don't have a losing trade anymore. Altogether, this is 26 weeks, and the gain is $5.1. So you still have 11% of ARR with this rollout strategy. I want to suggest, depending on your assumption of the stock movement after big drop, you should modify this strategy. If you think the stock will rise above the strike price in a few months, it's better not to lower the strike price. The final summary slide. I know this is a lot of information, and 2 parts of the complete guide add up to almost 1 hour of video. If you remember anything I talked about here, I want you to remember these 4 points. Put selling is risky, but time value is your friend. Annual rate of return is how you measure your success. Use this to guide your decisions, let it be opening a trade or closing a trade. Your portfolio should be diversified. And don't panic when you get a losing trade. Please remember the stock will eventually bounce back. So I'm going to stop here and wish you a happy trade. Again, don't forget to like and subscribe. And if you have any questions regarding trading, please shoot me an email or leave comments here. Bye.